All right, let's talk about something that confuses a lot of people, especially if you're self-employed. Bank statement loans. And honestly, this is one of the biggest aha moments for business owners who are trying to buy real estate but haven't been successful yet. Growth mindset. So here's the issue. If you're self-employed, your tax returns usually make it look like you make way, way less money than you actually do. It's because you're writing things off, which is smart. Everybody does it. You're allowed to do it. You want to pay Uncle Sam as little as possible at the end of the year. But then you go to buy a house, and the bank goes, cool, but based on your taxes, you make nothing. So you think of it like this. Imagine you go to the grocery store every week, and you spend $200. And at the end of the year, you tell somebody, actually, I only spend about $50, or it only cost me $50 a week because I have coupons, I have discounts, I can write some of it off. Now someone's trying to figure out your real spending habits, but all they see is the discounted version. That's basically what's happening through tax returns. So this is where bank statement loans come in. Instead of looking at what you wrote off, they look at what you actually bring in. So we use 12, 24 months of your bank statements to calculate your income based on just what's deposited into those accounts. So instead of what did you report after deductions, which is usually a disqualifier, we're asking what actually hit the bank account. That's a big difference. So this works really well when you're a business owner. You're self-employed, you're commission-based, you're a sole proprietor, you receive 1099s. Heck, there's even bank statement loans if you're a W-2 working in a cash-based business. You're a server, you're a bartender, anything like that. Basically, if your lifestyle doesn't match what your tax return says, this is for you. Now, there's a quick reality check with this. These loans usually come with a little bit higher interest rate, maybe a quarter point, maybe a half a point. Sometimes it's a larger down payment. You can't enter with 3 or 5% down for a bank statement loan program. But for a lot of people, that's the difference between qualifying for the home that you actually want versus getting stuck with not qualifying for anything at all. So at the end of the day, it's just a different way of looking at your income. It's not better, it's not worse, it's just more realistic for how business owners actually operate.